If you're putting money away for retirement, this year's been a rough ride in the stock market. The S&P 500 index recently dropped to a level 24% off its January high. That's a loss on paper, at least, of about a quarter of your portfolio. But panicking and trying to get out of the market, that could be a very bad move. Here to explain why is Sandy Wiggins from ACG Wealth Management. Sandy, welcome as always.
Great to be here.
All right, before we talk about that and the long-term sort of prognosis here, today, we got the inflation report for September, 8.2%, disappointing. It makes investors wonder, have we not hit peak inflation? Is the Fed going to stay as aggressive in raising the rates? Why did the stock market go up so much today?
It's a great question, and I'm not sure I can answer with any conviction. You know, a lot of it has to do just with people in their worry, and the VIX index, which we've talked about. The fear indicators are just really high, and so, people are giving up.
But they somehow picked today as a day to buy back in because the market's up 2.6, 2.7, almost 3% in some cases.
Yeah, it doesn't make a lot of sense, does it?
All right, which is why. But that's probably the proof of the adage that stay the course. Don't get all panicky and pull out. And you've got this, well, there's a well-known theory that when the market goes down for whatever event, the chances are when that event ends, whether it's a recession, whether it's actually the collapse of the housing market or the pandemic, that the days following are when the market has some of its great days. Can you talk about that?
Yeah, the bad days certainly are painful, but the good days tend to cluster around those bad days, and so you want to be in the market. And I think we have a graph that we'll talk about in a moment that really drives that home.
Right. Well, let's put up that graph right now, because essentially what it says is, and we've always heard this, that if you stay in the market year in, year out, that in the long haul, you're going to see some of those returns. This one, it's not quite as clear to see right here, but that shows basically the S&P 500 index there, and those green boxes all delineate points where the market went down because of some big event.
Right.
So, and tell me about those days that come back up, because it basically boils down to the days that you're out of the market when you said, okay, I'm not going to invest this week or this month because the market is down so far. Bad things happen. Like you can almost talk about like 10 days or 20 days.
Yeah. So if you look at use the S&P 500, Putnam, a big investment firm, did a study. For 15 years, ending 12/31/2021, if you invested over that period in the S&P 500 index, you would have gotten an average return on an annual basis of about 10%. But if you missed just 10 of the best days over that 15-year period,
just kind of short-term fear, but you pulled out and happened to be those 10 best days.
You missed days like today, and your average return is cut in half to 5%. If you missed 20 of the best days over that 15-year period, your return is cut down to roughly 1%. If you missed 40 of the best days, your return actually is negative on an annual basis of about 3%. So missing just 40 days over a 15-year period, your return suffers tremendously.
Like I'm glad I have an expert here, because I'm not an expert, but I had a colleague ask me, the market has been so terrible all year, should I maybe not contribute as much in my 401k each pay period because the market is so terrible right now? And that you're saying essentially stay the course. Definitely do not do that, because you will miss those good days.
Yeah, it makes sense. You know, maybe emotionally you want to stem the pain and suffering, but there's a lot of opportunity right now in the market. Stocks are cheap. Bonds are actually paying higher interest rates than they have in a very long time. So if we look at those elements, now's a good time. A wise investor told me one time, think of your portfolio as a bar of soap. The more you handle it, the smaller it gets.
That's an excellent point. Sandy Wiggins from ACG Wealth Management, thank you, sir, as always, for coming in.
Glad to be here.
All right, let's end it.